Hello everyone. In this video, we are going to see about short-term finances. So, what is short-term finance, and what are the short-term finance available? We are going to see in this particular video. So, yes, what is short-term finance? So, short-term finance refers to financial needs for a short or a small periodic, normally less than a year or less than 1 year. In a business, it's also called as an working capital or working capital finance. This type of finance is normally needed because of uneven flow of cash into the business, the seasonal pattern of the business, etc., and so on. So if you take short-term finance, so the majority is during seasonal times, during a kind of functional times or during Diwali and so on. The most of the products is seasonal based products also we are having. So based on the seasonal products, what they want to do is not all the 12 months they want to have the same capital or same working capital and so on. Certain period of time they need more capital for as an operating cost or for an capital cost also. So they want to get certain amount to run that particular business for that particular seasonal time, or certain business have such kind of things. So in such manner, you have to get loan for a short term, or within a year you have to get certain amount from a bank or some other financial or non-financial uh, banks or financial institutions, and you have to get it and you have to run that particular business. Out of that particular business, what you are getting out, you have to sort it out with an interest, and you have to take profit out of it. Yes, it's a kind of leverage concept. Within a short time, you can able to get more revenue out of it, so that you are getting the loan and you are making it happen, and you are repaying that particular amount as well as interest to that particular financial or non-financial banks, or even it's a kind of loan and so on. So short-term finances within a year, if I am getting and if the kind of transaction of financial securities and so on, it's a kind of short-term finance. So yes, so in short-term finance, we'll see a few short-term finance, how we can get a few short-term finance on things. The first one is overdraft. What is overdraft? So an overdraft is an extension of credit from a lending institution or lending financial institution that is granted when an account reaches zero. The overdraft allows the account holder to continue withdrawing money even when the account has no fund in it, or has insufficient fund to cover the amount of the withdrawal. Basically, an overdraft means that the bank allows customer to borrow a set of amount of money. There is an interest on loan, and there will be typically a fee per overdraft. So let's see what is the concept is all about. So overdraft. If I am having a bank account, if I am running a business, if I am having a bank account in my organization name, even that particular account not having fund, or my fund is zero, or my account balance is zero, I can able to withdraw certain amount uh, in the name of overdraft. So if I am running a particular small, medium enterprises or something, uh, definitely I want to circulate my cash flow, or a kind of circulation will happen. For it, what can I do is I can get a certain amount from the bank as an overdraft, even my bank balance is zero, or if I am not having a kind of balance in my account, then I can able to get certain amount. So certain accounts will have 2.5 lakhs as a limit. Certain bank will have 5 lakhs. Based on the business and based on that particular money circulation and cash flow, we can get certain amount. For that particular overdraft amount, we have to pay interest. That's the thing. If my bank balance is zero, if I am not having any fund, but I urgently need 1.5 lakhs, I if my bank provides me overdraft limit up to 2.5 lakhs, I can able to get 1.5 lakhs in my overdraft. I can use it in my business. Once after receiving my amount, I can repay that 1.5 lakhs with the interest for it. So that is called as overdraft. That's all about it. Fine. Yes, even my amount or even my account have zero as a balance, I can able to get certain amount from the bank as an overdraft limit, so that I can use that amount and I can pay the repayment amount as well as interest for that particular amount. So that is called as overdraft. Next, next we'll see one more thing, trade credit. So let me make it more simple so that you will be understand what is trade credit. So if you see a more small scale or small kind of business, what they will do is they won't give money just like that. What they will do is, in most of the firms, what they in most of the shops, retail outlets, what they will do means just they will get the items or a kind of products. What they will tell us, once I sell this particular product, I will give the amount. Usually, if you take, let me put it in Tamil, in a kind of grocery shop or மளிகை கடையில என்ன சொல்லுவாங்கன்னா, if the agents come, what they will do is they will get the product. They will tell to the agent is, once I sold out this 10 product, I will give that particular amount. Yes, first they will get that particular 10 to 20 products without giving any money. Once that 10 to 20 product gets sold, they will give that particular amount. By having profit alone with them, they will give the remaining amount to that particular agent. If the particular product does not get sold, they will return back to that particular agent. So this is called as trade credit. So trade credit is the loan extended by one trader to the another trader. The kind of exchange. One materialistic product is changed to another person. A trade credit is a loan extended by one trader to another trader when the good and service are to be brought on credit. They are not paying the cash or the amount immediately. They are getting that particular goods or service for the just as an credit. They want to hereafter only they want to credit once they sold. So trade credit facilitates the purchase of the supplies without immediate payment. They won't pay it immediately. Trade credit is commonly used in the business organization as a source of short-term finance, because whatever they are having, they can't spend for some other product. What they will do is just they will get it from their agents and they will have it. Once if it is get sold, they will give that particular amount and they will be having profit with them. So this is what it's going on in every grocery shop or kind of small commercial shops. This is how its trade credit works. If I am running a business is like retail outlet. Just assume like retail outlet. What that particular retail outlet will do is they will have a kind of suppliers like agents who provides that particular product. Here I have mentioned. So this is what the supplier who gives that particular product may be tangible or intangible, may be goods or service, but it will be given to a retail outlet without any payment, without any immediate payment. Once that particular retail outlet receives that particular product or service, they will be selling to their customers or consumers, end customers or end consumers. Once they get amount from their customer and consumer as an money, they will be receiving. That retail outlet will receive. That retail outlet, what they will do is they will have the profit alone with them and they will pay back the product price to the supplier for the next when they come for next turn. If the product remains unsold, they will return it back as a product. If product is sold, they will be returning as a money. This is what trade credit is all about. Fine. So one more thing we'll see in this video. The another short-term finance is factoring. So factoring is a financial transaction and a type of debt finance in which a business sell its accounts receivable, that is invoice, to the third party called as factors at a discount. A business will sometimes factor its receipts asset to meet its present and immediate cash needs. So it's like third party will be get involved. What is factoring? Let me explain through this so that you will be aware about what is factoring and things. So factoring process is all about there will be seller, there will be buyer, the third party will be calling as a factoring. So in factoring, there will be three parties. First one is seller, second person is buyer, seller and buyer, and third party is factoring or a kind of factor. Let me explain in this particular chart so that you will be easily understanding what is how the factoring is works. So yes, so the third party will be this is the supplier who supplies that particular product or who sells that particular product. This is buyer, a customer, a end customer or a customer who wants to buy that particular product. There will be intermediate persons. We will be calling as a third party. Here, my third party or factoring person will be my financier or a financial institution, or we can call it as a bank. What I will be doing is, first of all, I want to give through my purchase platform like Flipkart or Amazon. First, I want to order that particular product through a kind of forum like Flipkart or Amazon, so that what it can be done is, once I will be seeing in Flipkart or Amazon, I will choose my own product, what I want to purchase. I will be selecting so that that particular thing will be conveyed to supplier. So supplier will ask for that particular, okay, we will be providing. Finally, the supplier will deliver that good invoice to the buyer. So how it goes is, the particular buyer will pay for it. So the three the platform as well as supplier, the buyer also will get that money out of it. Here the third party is your financial banks or financial institution. Here the factoring person is financial institution or bank. This is how the factoring is works. Thank you.